and a bit of a cooling off from the market activity last week, which saw bond yields rise dramatically, particularly the 10-year bond, which I think Guy keeps bringing us back to, and correctly so. Why is the 10-year bond so important, the rate on the 10-year bond? Can anyone tell us? Okay, it's the most volatile, but to what particular instruments is it tied? What particular?
Mortgages.
It's tied to mortgages and consumer loans. So whether it's car loans or other types of loans, yes, it's a major benchmark for consumer loans and mortgages. If we look at consumer spending here, the first chart, that was Friday, and then we look at the inflation rate. What do we see the longer term trend here on the inflation rate is what? It's upwards. So the combination of a jump in investors in consumer spending, a trending upward inflation rate, all leads to what conclusion? That the economy is expanding, and eventually the Fed's going to have to increase rates, because what we're going to see is inflation that will surpass 2%. The question is once it surpasses 2%, what kind of effect is that going to have on the stock market, and to what extent is the Fed going to be compelled to act? With that question, let's take a look at the Treasury market.
Professor?
Yeah.
Do you think that the action that the Australian central bank did today also pushed the market a little bit?
Tell everybody in the class what the central bank did today. What did the Australian central bank do?
They usually purchase or sell bonds, and today they purchased another 4 billion Australian dollars. So maybe it gave some confidence to investors.
So what are central banks doing? Because it's not just Australia that pushed back against Friday's market activity. Central banks around the world are pushing back against higher borrowing costs, against higher rates. That's why you saw the yield on the 10-year come down from a little over 150 down to 140 and change. But good comment there, Sahar. Let's look at where we were last February, just before classes were suspended. In fact, our last day of class was, Baruch was closed on the 11th of March. So just previous to that, when we were looking at 3.5% unemployment rate before the COVID-driven recession led us to lose over 22 million jobs in a period of 2 months. What did the yield curve look like? The 1 month was yielding 159. The 30 yield was yielding 181. What type of yield curve of the 4 yield curve types that we looked at is this?
Looks like fairly flat.
This is a flat yield curve. Yeah. Thank you. So it's a flat yield curve. It's consistent with uncertainty about the economy. At this point last February, weren't we all at that point aware that COVID was slowly moving around the country? There were more than just a few cases. Yes? And so there was tremendous uncertainty about what effect that was going to have, as more and more voices were sounding the alarm about what was expected to be a major problem. And of course, it became a major problem very quickly. And so far, we have soared past those initial numbers, and the numbers have become extraordinarily high. But again, the yield curve back in February reflected conditions then, and both optimism and the real driver here was uncertainty about the direction of the economy. Let's move on then and look at the yield curve at the beginning of this year, back in January. What's going on here? What type of curve is this?
Normal one.
On the 1 month end, we're looking at 9 basis points. On the long end, we're looking at 166. Pardon me. So this is is it a steep curve or normal curve, a flat curve or an inverted curve?
Steep.
This is a steep curve. That's exactly right. Now let's take a look at last week's activity and today's activity. If you look here last week, I believe the guy, I don't know if he's here tonight, he brought our attention to the 10-year bond, which on Wednesday was 138 where I'm pointing. On Thursday, the 10-year went above 150, the all-important psychological barrier of 150 basis points, to 1.54. We ended the week at 144, which, if I'm not mistaken, is a little over 50% greater than where we were at the beginning of the year. We see central banks pushing back against higher rates today, keeping the 10-year below the 150, the important psychological level of 150. So on Thursday, we reached the highest level in 1 year. And as we pointed out, the 10-year is closely tied to mortgage rates and consumer loans. So as we said, what's really going on here? Well, again, this is a steep yield curve. We show that the 3-month 20-year spread is greater than 2%. Here it's 220 basis points. No, I'm sorry, between the 3-month at 5 basis points. So it's a little under 220, 218 basis points between the 3-month and the 20-year. So clearly a definitive steep yield curve with the expectation the economy is going to quickly recover. The passage of the Stimulus Act this weekend and the vaccine news, of course, is going to further cement that consensus opinion. So what's going on is that the rising yields reflect the market expectation that we're going to see accelerating growth and rising inflation. So additional stimulus, widespread vaccination, all of which will help the economy expand rapidly. What's the big but here? The big but here is that while the Fed says that that's healthy, rising rates reflect a healthy, expanding economy, it also equates to higher borrowing costs. So investors have to decide to what extent do they want to reevaluate their investments, maybe move investments out of bonds into equities, and also to consider what their longer-term borrowing costs are. And as we said today, and as Sahar pointed out, Australia, along with other central banks, are pushing back vigorously against higher rates because higher rates could undo the easy money policies of the central banks around the world that have been pushing the yield curve down in order to stimulate borrowing on the long end of the curve. So I wanted to address the yield curve today with you. Are there any questions here about where we are? Okay, good. Again, thanks to Guy for calling our attention to it. Let's move on and return our attention to a trade and our production possibility frontier, or our production possibility schedule. So here we have our simple two-product nation, which is producing refrigerators and cars. If the nation is producing at X, is it efficient or inefficient?
Inefficient.
It's inefficient. If it's producing at A, B, or C along the PPS, of course, we would say that it's efficient. It's an efficient use of the nation's resources. Is it possible for the country, the nation, to be producing at Y or to produce at Y in the future?
Oh, it's not tenable.
In the future, maybe, but not for now.
It's not.
Right. The key is that the production possibility schedule can expand. What leads the production possibility schedule? The productive potential of the nation to be able to expand. What are the key drivers there? Think about it.
Resources.
It's money, and what else?
Money, technology.
Money and technology. That's exactly right. Thank you. So the production possibility frontier is concave because, of course, factors of production are imperfect substitutes for each other, as we've talked about before. Yes? And so we see that here the nation is producing under increasing cost conditions. The question, though, for you is, what if the schedule is a straight line? Does anybody have any thoughts on that? What does that mean, that if it's a straight line?
That everything is perfectly substitutable?
That's exactly right. Therefore, that the factors of production would be perfect substitute for one another. You would observe constant opportunity cost, which is instead of a concave production possibility schedule, a straight line schedule with the factors of production, as Shaya just said. Did I pronounce that correctly? Is it Shaya or Shaya?
It's Chaya, but close enough.
Chaya. Well, then I'm going to make sure to pronounce it right. Thank you very much, Chaya. So, as Chaya pointed out, they're in fact perfect factors of production are perfect substitutes for one another when we see a straight line production possibility schedule. Yeah?
So, Professor, does it mean that the marginal rate of substitution is always constant?
It means the rate of transformation is always, the marginal rate of transformation is always constant with a straight line production possibility schedule. Good question. Yes. When we use the term autarky, that means a complete absence of trade. So a nation like North Korea, we'd say, effectively exists in a constant state of autarky because it doesn't trade. The terms of trade are the rate at which one nation's export are traded for another country's exports, the rate at which they exchange goods. So here, God bless you. Okay. So here we look at we can plot the marginal rate of transformation of wheat here on the y-axis into autos. Yes. So we see that 30/60 means the marginal rate of transformation here is going to be 1/2. What is the marginal rate of transformation of bushels of wheat into cars? We just set up the fraction 30/60, which gives us 1/2. The relative cost of producing one car then is 1/2 bushel of wheat. Does everybody understand that, I hope? If there are any questions, give me a shout out. Okay, this is basic building blocks as we begin to consider the welfare effects of trade as we move on throughout the chapter. So here, we're going to talk about gains from specialization and trade under constant opportunity costs. So here we see the US with the various combinations of goods that, in this case, each nation can produce given the availability of factors. We look at the US and Canada. So here the US and autarky can produce 40 cars and 40 bushels of wheat. Canada can produce 40 cars and 80 bushels of wheat. So here we are at point A in both nations at pre-specialization autarky. So as we said, we laid out the production capacity of both nations before trade begins. Okay. Now we say with complete specialization and based upon its production possibility schedule, what the U.S. can produce, given all of its available factors, is 120 cars or 60 bushels of wheat. So where does the U.S. have a comparative advantage here in terms of its productive capacity in the production of cars or wheat?
Cars.
Cars.
Fantastic. That's right. In the production of cars. Very simple, straightforward. Very good. So let's break this down. So the U.S. is doing 40 and 40 before specialization. All their factors of production are oriented then towards the production of cars. They can produce 120 cars. They can produce 120 cars, which shows a net gain of 80 cars, but a loss of 40 bushels of wheat for the global market. But now let's take a look at Canada. After autarky, once Canada specializes and uses all of its factors of production for either the production of wheat or cars, it can produce 160 bushels of wheat or 80 cars, which leads us to conclude that Canada's comparative advantage rests with the production of wheat as opposed to cars. I'm assuming that everybody agrees with that, yes?
Yes.
Good. Okay. So we go back to our chart and we see again here, Canada was at 40 and 80 autos and wheat respectively before specialization. And then after specialization is producing 160 bushels of wheat and no cars for a net gain of 80 bushels of wheat. However, a loss of 80 cars on the world market. But once we put everything together, what do we see? We see that the real net gain is 40 cars and 40 bushels of wheat for the global economy. As a result of what? Specialization and exchange, a concept that we've talked about or introduced over the course of the last couple of weeks. And the basis by which we say that nations should trade. They should specialize in what they're good at and exchange for those goods and services where they don't maintain a comparative advantage. So these are production gains from specialization. So all that is happening really is that resources are being reallocated and used more efficiently. Canada is moving resources that were producing cars into the production of wheat, which is where it maintains a comparative advantage. Similarly, the US is doing the same thing with cars, and both nations are able to experience static gains from specialization that we see here. Remember, it's resources are being reallocated more efficiently. Okay, so from here, we say that under complete specialization, the US can produce 120 cars, 60 bushels of wheat, Canada 160 and 80. Again, static gains from specialization, a reallocation of resources on this slide. Now we want to calculate the marginal rate of transformation. So the marginal rate of transformation in the US 60 over 120 means half a bushel of wheat equals one car. In Canada, what does it equal? 2 bushels of wheat or equals one car. How do we get that? 120 over 80. It's a simple fraction, 2 bushels of wheat per one car. What is that? As we discussed last week, that's the opportunity cost of the product. You know what? Let me just pause here for a second and ask you a question. What is the opportunity cost of being in this class right now for
Sleeping.
you?
And go to
Sleeping.
Excuse
Studying.
me?
Working.
Working, or the best alternative to this class. It may be working, it may be doing something else, but the best alternative to whatever this
Not
activity
paying.
is.
Not paying for it.
That's good. Very clever, very clever. But yes, it's the best alternative to the activity. But here we are. What we're illustrating here is the opportunity cost of the product via marginal rates of transformation, specialization, and exchange. So we say that the US and Canada agree to a terms of trade ratio on a one-to-one basis, where 1 bushel of wheat is exchanged for 1 car. TT, as you see in the US, as I've drawn here, designates the trading possibilities line. Okay? We see the same thing in Canada, where TT designates the trading possibilities line. Okay? Now, what's going to happen? In the US, follow my cursor here, the US is going to move up its trading possibilities line until it's exported 60 cars, at which point it will have imported 60 bushels of wheat. At the same time, what's Canada doing? Up here, Canada is moving down its production possibility schedule until it's exported 60 bushels of wheat and imported 60 cars. Those are consumption gains from trade. We looked at production gains from trade. This is consumption gains from trade. US is moving up its production possibility, trading possibility line, and Canada is moving down its trading possibility line until it comes to an optimal point, which gives us our trade triangle. The trade triangle, as I indicate here, shows us the exports, imports, and the terms of trade, where one country's exports equals another country's imports. Are there any questions here? Excuse me? Okay. So this graphing that we're starting now is an important concept and one that you will be tested on, and you will be tested on both in exams and on homeworks that you'll do. And as we're going through it with increasing degrees of complexity, I encourage you to ask me questions, to raise questions in class. And of course, if not here, come back to me through emails, as certainly many of you have already done, which is great. I want to encourage that. So again, let's look at the numbers more closely. We looked at gains from production gains from specialization. Now we're looking at consumption gains from specialization. We see before and after trade with the net gain or loss both in the US and Canada. And what we see is that after trade, that there's a gain of 120, that there's a total of 120 cars in the market and 160 bushels of wheat, which equates to a gain of a net gain for the global economy of 40 cars and 40 bushels of wheat. So that we can say there are consumption gains from trade as more of each good is being produced, as opposed to just a static reallocation of resources. These are gains as a result of trade. Okay? In the first case, we were reallocating resources from one thing to another. Here, we are we have gone from autarky to specialization to trade, and we can indicate the consumption gains from trade once that's been undertaken between Canada and the United States. Are there any thoughts or questions here you want to raise? Okay, then let's move on. Okay, so here we are. We see the US and Canada with post-specialization production points indicated, pre-specialization points indicated, marginal rates of transformation. And we see the cost ratio in the US is 1/2 to 1, and in Canada, it's 2 to 1. So what we can do here is we can take the negatively sloped production possibility scheduled, these straight line production possibility schedules, and we can flip them over into positively sloped cost ratio lines. So these production possibility schedules here in the US and Canada become cost ratio lines. Those cost ratio lines become the no trade boundaries beyond which trade doesn't exist. The region of mutually beneficial trade, when we graph this, lies between the cost ratio lines in here. And depending upon the intensity of each nation's demand for the other nation's good, the result will find either that the US terms of trade will improve or Canada's terms of trade will improve. So again, the cost ratio lines are translated from the negatively sloped production possibility schedules and become our no trade boundaries. Okay, so as we say, the cost ratio line determines the out of bound limits. It's the reciprocal demand that determines the terms of trade within those limits. And we, as I said, here we have the region of mutually beneficial trade. So if the US is more eager for Canadian wheat than Canada is for the US cars, then what's going to happen is that trade's going to end up closer to the US cost ratio line. Conversely, if Canada is more eager for US made cars than the US is for Canadian made wheat, then the terms of trade will be closer to Canada's terms of trade. As I point out here, the post-trade consumption has to be at a point at least along the PP, along the schedule, as well as within here. The terms of trade must be more favorable than or equal to the rate defined by each nation's cost ratio. So Canada is not going to trade 2 bushels of wheat for less than 1 car, is what that means. The US is not going to trade 1 car for less than half a bushel of wheat. Okay? So the US shouldn't trade cars for wheat at a ratio of less than half a bushel of wheat for 1 car, in Canada at a ratio for cars. Excuse me, I'm getting ahead of myself. Canada shouldn't trade wheat for cars at a ratio of less than 1 car for every 2 bushels of wheat. Okay? So as I said before, if Canadians are more eager for US cars, the terms of trade end up close to Canada's cost ratio line, and the US terms of trade are improving. Conversely, if Americans are more eager for the Canadian wheat, then the terms of trade end up to the US cost ratio of half a bushel of wheat equals 1 car, and Canadian terms of trade are improving. I'm sorry if I, excuse me, I'm sorry if I stop there for a second. I'll be right back. Are there any questions there? Shall I go over it again? Okay, well, fair enough.
So
Let's.
I just have a question.
Sure,
I
go
just
ahead.
have a question here. So what this is basically stating is, like, in between these two, like this is the region of mutually beneficial trade.
That's
so
exactly right, just like it says there. The outer
outside
bound
of those
limits
limits.
are the outer bound limits of the cost ratio lines here.
Okay, so out of those limits represent things like if you know, obviously they for Canada, for example, they traded 2 bushels of wheat for less than 1 car. You know, like, so those are those
But we're
regions
saying that
out-
they're not going to, because they could.
Right.
Why would they do that if they can just produce domestically? The only
Okay, so
advantage of trading is that they should get at least what they're getting at home,
right.
if not more. Okay.
Got it.
Okay. Okay. So now that we've put that away for the moment, talking about marginal rates of transformation, chapter 2 goes to some length discussing the evolution of modern trade, and I want to spend a little bit of time talking about that. We discussed that last week, and we've been talking about since the beginning of the semester, John Keynes and Keynesian economics, because Keynesian economics establishes the foundation of modern economic theory. And for anyone that's paying attention to the news, it's a phrase that's been invoked many times over the last number of months as we've been confronting this unprecedented contraction in the US economy, unprecedented since, of course, the Great Depression. We've seen an enormous loss of job, an enormous loss of life, and a stagnated economy with the expectation or hope that based on Keynesian economics, the combination of active fiscal and monetary policy is what's necessary to prop up the economy, encourage growth, which is why we're seeing the Fed stand by low rates, and why we've just acknowledged that the Biden administration has successfully been able to spearhead the passage of a nearly $2 trillion rescue package, which is more than twice the size of the initial rescue package proposed or passed under the Obama administration during the Great Recession. So, but before we get to Keynesian economics in the 1930s, which of course is was the concept that informed Roosevelt's actions during the Great Depression and created the framework for the New Deal, that essentially, not essentially, that is the precursor to the social safety net that we have today, whether it's Medicare or Social Security or Medicaid or all the other programs that support the economy, both business, consumers, citizens, so on and so forth. But before we get to John Keynes in the late 1920s and early 1930s, helping US presidents address economic crises, we have to look further back. And we look back, and we've already discussed this over the course of the last couple of weeks, the last month or so that we've been in class. We talked about mercantilism. We drew a thread between mercantilism and Trumpism, the idea and the Trump-driven trade war, tariff-driven trade war, the idea that trade is a zero-sum game, that a nation should encourage exports and discourage imports, that a nation should have as much wealth as it possibly can. Under mercantilism, the idea was that a nation's status was determined by the amount of precious metal that it held. The idea was that global wealth was fixed, and that trade was a negative zero-sum game. Excuse me. As I said, national wealth was determined by the amount of precious metal loaned, and to be wealthy, the nation had to export as much as possible and import as little as possible. The key here is that mercantilism encouraged nations to maintain a trade surplus that was promoted by encouraging exports and discouraging imports. Can anyone tell me what's the problem with the idea of a nation trying to accumulate precious metal while at the same time trying to maintain a trade surplus? Well, in 1754, between 1754 and the 1850s, we see a big transition. We see a transition from mercantilism to modern economic theory, and then, classical economic theory onto the beginnings of modern economic theory, just before John Keynes really defined modern economic theory for the 20th century, and now, of course, in the 21st century. David Hume comes along in 1754, and he says that a favorable trade surplus is impossible in the short run. Why? Because of the price-specie flow mechanism, which says essentially that a nation that only encourages exports and is taking more and more silver and gold, and what's that going to do to price levels in the nation?
Increase the price
It's going to
levels.
increase price levels in the nation, which means that the value of the currency is going to go up, and that's going to mean that the nation itself is going to be importing more and more and exporting less and less. And that's going to do what? That's going to eliminate the trade surplus. That's exactly right. So increasing gold and silver inflows from trade leads to higher price levels relative to other nations, a decline in exports and trade surplus being eliminated. So the predominant trade theory for 300 years of mercantilism, 1754, begins the untangling of that theory, first by David Hume in the 1750s with the price-specie flow mechanism, and then, very importantly, and of course, someone that I expect many of you to have heard of before, is Adam Smith, who publishes The Wealth of Nations in 1776, also the birth of this nation. And he says what? That trade is not a zero-sum game. I mean, this was a revolution in thinking for the time. Trade is beneficial to everyone. It leads to increased production, consumption, and world output. This directly contradicted predominant thinking, which is mercantilist theory. He said that the labor theory of value establishes that labor is the only factor of production, that it's homogeneous, and that the cost of a good depends entirely on the amount of labor required to produce it. So that's very important, the labor theory of value. So the big change here is that trade is beneficial and that labor is the only factor of production. And finally, that trade should be based on absolute advantage. So you have the labor theory of value, labor is the only factor of production, and trade based on absolute advantage, rather than what we have been talking about now, of course, is the idea of a comparative advantage. Back in 1776, we saw a big leap in thinking away from mercantilism. Yes, Luis?
Louis, yeah, Professor, could you provide?
Louis? Is it Louis or Luis?
Yeah, Louis.
Louis.
Yeah, could you just provide more context on the labor theory of value? Could you explain that a little more? Thank you.
Labor theory of value is that labor is the only factor of production. It didn't take into account multiple factors of production. That didn't happen until Hedge in the 1920s. So we're not up to Hedge in the 1920s in the factor endowment theory. Here we are in 1776, and the theory was that labor is the only factor of production. I don't have much more color to give you on that in terms of a frame. That thinking persisted for over 100 years, that it was the only key factor of production. In fact, it continues through David Ricardo back in 1850, who introduces comparative advantage. So, as I point out here, my last point here, he talked about Adam Smith, that a nation should trade based on absolute advantage, and that it should export goods where it has an absolute cost advantage and import goods where it has an absolute cost disadvantage. Okay?
我觉得我这个太长了，兄弟。
Pardon me?
Eh.
Okay. Louis, was that okay?
Yeah, thank you. I just wanted a little more color on that. Thanks, Professor.
Okay. So moving along, we introduced this last week. Last week, I gave you a summary sheet on classical economic theory and modern economic theory. And we talked about Say's law and the idea that supply creates its own demand. This is really the fundamental thinking behind classical economic theory. The idea that supply creates its own demand. If you build it, if you produce it, there'll always be enough money in a fully employed economy to absorb all the goods and services that the economy can produce. And this was a critical piece of classical economic theory, the idea that full employment is achieved, the idea that full employment achieved on its own, that an economy will operate at its full potential automatically, which is a signal for government to do what?
Stay out of it.
Do nothing.
Not
Keep your
intervene.
hands off of the economy.
Interfere.
Keep your hands off of the economy.
Professor, does this apply even when there's like drastic income inequality like we've seen in recent years?
It does apply when there's drastic income inequality. If you're a classical if you believe in classical economic theory, if you believe that any, well, yes, it does. It does.
According to the theory or like in practicality?
According to the theory. According to the theory. There are people that believe any redistribution of wealth from any redistribution of money or funds, wealth from wealthy people to low-income people is an incorrect meddling in the proper functioning of the economy, and that the government has no right to meddle or interfere with that function. As I said, he said that the economy is going to operate at full potential automatically, and spending is always going to equal, as I said, absorb all the goods and services of a fully employed economy. The economy will always be fully employed. Total spending will always equal total output. That is fantastic. Think about that. If you are the government, the prevailing theory is total spending will always equal total output. All of that's good until what happens?
Deflation.
Great Depression.
All that's good until you have a problem, until something goes wrong. Because the weakness of the model is what? It doesn't consider short-run disruptions to longer-term trends. One of you just referred to the Great Depression. Well, of course, that was the 90-mile-an-hour train that blew up Say's law, the theory of Say's law, that supply creates its own demand, that spending will always be enough to absorb all the goods and services. We know that that's not true, but it took a while to get there. So following Adam Smith in 1776, Jean-Baptiste Say established Say's law and the notion that supply creates its own demand, and this is a cornerstone of what is classical economic theory. Following him, as I said, doesn't consider short-term disruptions. I say Great Recession, Great Depression, Great Recession, COVID recession. Of course, any contraction contradicts classical economic theory, which says that doesn't happen. And if it does happen, the economy will automatically correct itself. We know that that isn't true, which is why modern economic theory advocates for aggressive monetary and fiscal policy action in order to stabilize output and encourage growth, employment, et cetera, et cetera. Going back, though, to the early 1800s, we have these very progressive thinkers for the time, Adam Smith, Jean-Baptiste Say, and then, of course, what many consider to be the father of modern economic theory, David Ricardo, who comes along, he starts talking about comparative advantage and the logic of free trade. He talks about trade being based on relative, he says that trade should be based on relative efficiencies and on the low-cost producer. He emphasized trading gains based on comparative versus absolute advantages as a basis for trade. He said that efficient nations export goods where it's most efficient and imports goods where it's less efficient relative to other nations. He said that trade based on comparative advantage will lead to greater resource efficiency and higher living standards. One of you referred to income inequality, which of course is now at historic levels. I mentioned here in terms of living standards to remind us that we've already looked at some of those measures with the Gini Index and the Human Development Index out of the United Nations. Interestingly, David Ricardo in 1815 relies on Adam Smith's labor theory of value from 40 years before that labor, that labor is the only factor of production. And what he doesn't do, he introduces the idea of the logic of free trade and the notion of comparative advantage, nations trading based on relative efficiencies. But the deficiencies here is that he relies on Smith's labor theory of value, that labor is the only factor of production, and he doesn't tell us how the terms of trade are determined between nations. It's not until 1840, 35 years later, with John Stuart Mill. Excuse me, yes? If you're not making any comments or participating, you just mute your
I don't think he's aware that he's not on mute, Professor.
No, he muted himself. It's fine. You can go on.
So along comes John Stuart Mill to answer the question that David Ricardo did not, which is, how is the terms of trade determined? The terms of trade are determined by the reciprocal demand for each nation's of each nation for the other nation's goods, right? The relative strength of each country's demand for the other nation's product. What is the intensity of the trading partner's demand? Okay. He also said that two nations of unequal size, the smaller nation is going to be dwarfed by the demand strength of the larger nations. And we talked about global fallacies and myths. We said that that's not true, that small nations and large nations should trade together. There are enormous benefits for nations of unequal size to trade together. And there's no validity to the fact that, to this idea that John Stuart Mill introduced with regard to nations of unequal economic size trading together. However, the theory of reciprocal demand persists to this day and has been proven by many decades of research. So following John Stuart Mill in 1840, So between David Hume and John Stuart Mill, we see five thinkers: Hume, Smith, Jean-Baptiste Say, David Ricardo, and John Stuart Mill. We see a tremendous evolution from mercantilism and the theory of absolute advantage and only maintaining a trade surplus to one that is really very different, that is looking at ideas of comparative advantage and reciprocal demand as the drivers of global trade. We see then between 1817 and 1914, the first waves of globalization driven by the new technologies of the age, which was steam power, mechanized mass production, ships and railroads, plus falling tariffs, plus large immigration flows, plus labor mobility. What happens in 1914 to put a big stop to that?
World War One.
World War I. Thank you, Sahar. World War I happens in 1940, puts a big stop to that. Then what happens in, what do we see in 1930 with regard to America? So the reaction after World War I is that America retreats from global trade. And we see the Smoot-Hawley Tariff Act of 1930 that imposes tariffs on thousands of products with tariffs averaging over 50%. It led to a trade war. It leads to exports falling by 60% during, I'm looking at my notes, 1930 and 1933. So a complete reaction, completely away from where we were prior to World War I. As a result of World War I, America turning inward, much like we saw under the Trump administration, with America retreating from global trade, retreating from its role as a global leader on the world stage. And of course, now a return to that responsibility under the Biden administration.
Professor,
Yeah,
was there a specific reason we increased tariffs to such an amount after World War One? Like we just
yeah,
wanted to
sure. We
stop out?
wanted to protect domestic farmers. That's why. The belief is that we would be protecting domestic farmers. Were we right about that? No, we weren't right about that. Why? Because trade wars don't work. If you impose tariffs on other people's products, other nations' products, what do? They impose tariffs on your products, or they find other nations to buy their products from, like China did. When China, facing enormous tariffs from the US, bought its soybeans from other nations. Does that answer your question? That's the reason why we impose
Yeah.
tariffs.
Was there a
Protect the
specific
US agricultural
reason?
sector. Pardon
Was
me?
there a specific reason we wanted to protect our farmers? Were they facing any sort of issues?
They were facing tremendous issues. They were facing. We're talking about the beginning of we're talking about the Depression. The Depression is 1929 to 1939. The Smoot-Hawley tariff is 1930.
Oh, I see. It was put in right after the Depression. Okay.
This is an
I got
effort to help the agricultural sector. And of course, at the time, the president was Hoover, who didn't know his elbow from his hand. I don't want to say that. Let me rephrase. Hoover didn't want to acknowledge the famine and the famine that was sweeping the country, the food insecurity that was sweeping the country, the pain that was sweeping the country, and the advice that he was being given by people who challenged consensus thinking at the time, which was based on classical economic theory, which said what? Don't do anything. Don't do anything. Everything's going to be fine on its own. That, of course, led to Roosevelt being swept into office, Hoover being swept out of office, and the New Deal initiative that, of course, forms the bedrock of the social safety net that we all know of today. So we see the first wave of globalization followed by what? I point out Henry Ford, who we talked about earlier last month, who advocates for stakeholder capitalism and argued that the welfare of the company is tied to the welfare of its workers, just the way John Maynard Keynes argued 15 years later to Roosevelt that the welfare of America's citizens was tied to the welfare of the country, which is why he had to undertake a type of initiative that had never been undertaken in American history. Massive government spending and support to pull the economy out of the Great Depression, right? So here we are, we come to the Great Depression in 1929. As I said, the conventional wisdom called for strict monetary policy and deep budget cuts, much like the conventional wisdom in the US in 2008, 9, and 10. Here, on one side of the aisle, called for strict monetary policy and deep budget cuts. We saw the same thing in Europe, where in the aftermath of the credit crisis of 2007 and 8, there were many people who advocated for strict monetary policy and deep budget cuts, which did what? It only worsened the crisis and worsened the pain, whether it was for Americans or for the poor southern countries in Europe that could no longer afford the strong euro. We're talking about Portugal, Ireland, Spain, and most notably Greece. So Keynes comes along, and what does he do? At this point, you know this by heart. He argued for active policy responses during times of economic crisis, completely contradicting classical economic theory. What he did that was so incredible was he argued against conventional wisdom. He argued for the things that we could do, as opposed to the things that we couldn't do, which is what classical economic theory is based on, all the things an economy couldn't do. Okay, so what he said was that increasing demand, undoing negative cycles of unemployment, and stagnant range growth required putting together aggressive monetary and fiscal policy action in order to stabilize the output. He advocated for structural changes. He advocated for targeted stimulus spending. And you see that I've noted some of them, like research and development, entitled reform, export promotion, skill building, education, vocational training. And if you look at all the programs of the New Deal, you see examples of all of these types of initiatives that Keynes advocated for with Roosevelt. What he said was that increasing the monetary base through central bank asset buying would not be inflationary, and austerity would further weaken an already depressed economy. And even though we know that that's true from the Great Depression, there are folks that argued exactly that in 2008. And there are folks that have argued exactly that now. Yes, that what we need is austerity, that that the government shouldn't spend too much, that the government should hesitate before committing to large fiscal policy programs to support the economy, because it's going to hurt the economy over the long term. And we know that that's not true. We have many examples over the course of the last 100 years where recessions, contractions required government intervention in order to stimulate output and restore the economy. So a couple of noteworthy things that he said was that the boom, not the slump, is the right time for economy. It's when things are going gangbusters that you need to cut back, not when there's a slump like there is now. It's when there's a slump that you need the economy, particularly the government, to spend. And I point out here that you should see the bailout of the U.S. auto industry, record profits in the, you should see the auto industry during the Great Recession and COVID-driven U.S. and Eurozone rescue packages that are ongoing. As you pointed out, that there was not only the bond buying programs of central banks around the world, but of course the aid packages that are being initiated around the world, the most notable being the U.S. nearly $2 trillion rescue package that is coming through, about to come into the Senate, where I expect it will pass by a vote of 1, which would be the vice president's vote.
Professor, I have a question.
Yeah.
So it says that during the booms we should have austerity, but when we were in the bull market, we saw a lot of low interest rates, like 0%, like near zero, and then whenever we wanted to raise interest rates, there would be a pullback in the market.
You're talking about during 2000.
Yeah.
What year are you talking about?
Like
After the recession?
Like after 2008. There was like 10 years.
Talking about after the crash.
Yeah.
We see years of low interest rates. We see years of extraordinary central bank asset buying, keeping the yield curve low, keeping long rates low, and we see no inflation, right? And so the conclusion is what? Is that the old idea that there's a trade-off between lower unemployment and inflation doesn't really hold, because what we've seen is an explosive stock market. The stock market went to 6,500. The Dow went to 6,500 in 2008. And where was it when Trump came into office, or where was it now even? It's just under 32,000 or 31,500. I think when he came into office, it was about 26,000. In terms of inflation, it's non-existent. In terms of unemployment during the Great Recession, the U3 unemployment went to 10, 11%. And when Obama left office, where was unemployment? At 3.5%? And where was inflation? De minimis. It didn't, it's not, in other words, the old idea that there's that trade-off isn't true, just like now.
Oh, Professor, couldn't you make the argument that there is no trade-off because of our currency? Because we have the world reserve currency, and let's say if Russia or Venezuela did this, then there would be a different outcome.
Absolutely. That the U.S. is in a unique position because of the unique role of the U.S. dollar and the international monetary system. I agree with that. I do.
So
absolutely. Good point.
Because we were booming and we didn't slow down on the easy money policy, do you think that put us in a bad position for when the recession came? Because we were already like really low. Like how much lower can
You mean
we
when
get?
you mean when this recession came?
Because we were loaded up on a lot of debt. With that,
right. So in other words, are we looking at a bubble? Is what you're saying? Are we looking at a bubble? Are the 10 years of low interest rates from the Fed leading to a bubble situation? That doesn't seem to be the case. And the belief is that there's a lot of movement for the stock market to continue its upward trend. I'm going to say no. I'm going to say that the Fed, that the coordination of federal and the Federal Reserve and fiscal policy action under Obama and who is the Fed secretary under Obama? Who's the Secretary of Treasury now? Who is it? Janet Yellen. Under Janet Yellen and Obama, what we saw was a textbook rescue of an economy in crisis. That the economy was exploding, 700,000 jobs a month when Obama came into office, and they undertook policies and initiatives that were soundly rejected, soundly called out by people on the other side of the aisle, people that were critics, and they were proven correct. And over 10 years, what we saw is an economy come back to life, roar back to life. The one thing that we didn't see, unfortunately, was we saw a dramatic decrease in unemployment, a dramatic increase in the stock market. We didn't see was a dramatic increase in income for most people. We've discussed that before, and we've also discussed how that dovetails into rising income inequality and what a critical issue that is. So no, I don't believe that. I don't. The fear that low interest rates are going to lead to soaring inflation has been proven untrue in this economy. No.
Don't you think that inflation is one thing that can handle debt? No, I'm not saying high.
Well, say that again.
No, please go on. Sorry.
Oh, Professor, you said income wasn't rising.
I said that income has been relatively flat over the course of the last 10 years. I know that we looked at a chart. Income, it's been roughly 2.5% over a long period of time. That's right. We've talked about that. How there's a disconnect between rising costs and flat wages, flat stagnant wages. But that's a persistent problem in this economy.
I remember reading an article about deleveraging, where you have to have a higher rate of income or a higher percentage of increase of income compared to debt. So yeah, for economy to deleverage, raising there has to be a higher percentage of income increasing than debt increasing.
Okay, well maybe we're talking about a couple of different things.
I'm sorry.
Do you believe that there are people that argue the U.S. shouldn't borrow? The U.S. shouldn't borrow, shouldn't increase if the U.S. should not increase its debt, its outstanding debt, which is now well over 100% of our GDP, which begins to look like the debt to GDP ratio was in World War II. Not quite that high, but it's certainly higher than it's been in a long time. Should the U.S. continue to borrow?
I think our economy needs it
It has to.
because
Well, of
if we
course,
don't borrow, then interest rates are going to rise, and then we
if it
can't pay
doesn't
it
borrow,
off.
who's going to rescue the economy? Who's going
Yeah.
to put the money into the pockets of people that can't pay their rent or put food on the table or pay their car bill or pay their insurance bill or pay their health care bill or hospital bill? Who's going to do it at a time when we have millions of people out of work and tremendous, unprecedented, historic food insecurity? Who is going to do it? We're the largest, we're the richest, this is the richest nation on earth. I'm paraphrasing Dr. Fauci, who said over the weekend, a nation as sophisticated and wealthy as the U.S. should never have lost over 500,000 people. I can't say that any of us would disagree with that. A nation as rich and sophisticated as the United States that has access to the lowest borrowing rates that you could ever expect should certainly be able to continue to borrow at these historically low rates in order to address the shortfalls or weaknesses in this COVID-driven economy, COVID-affected economy. So that's an enthusiastic yes for Keynesian economics and all of these initiatives that are being undertaken. In fact, what I've done for you here, I'm not going to test you on this. I did this again like some of the other information I've given you. This is a summary of key New Deal programs under Roosevelt that transformed America and was informed by British economists who advocated for these types of programs and aggressive government involvement in order to stabilize output during times of severe economic distress. And of course, this transformed the country. If you look here in 1935, the Social Security Administration, I point that out because Hoover was notorious, and those that supported President Hoover for claiming that Social Security would bankrupt the nation. Excuse me. And as we know, Social Security is a cornerstone of America's social safety net and has not bankrupted the nation. I point out here also in 1933, the Tennessee Valley Authority, which has helped to modernize agrarian and farm-based economies around the world and has developed, as a result of the TVA, developed all sorts of innovations with regard to agriculture that have been exported around the world over the course of the last near 100 years. Okay. This is as far as we're going to go today on the evolution of trade theory. In the coming weeks, we're going to talk about trade theory after World War II in the 1950s, 60s, and 80s, and how modern trade theory continued to evolve past David Ricardo and the idea of comparative advantages in nations trading on relative efficiencies. But this was a good introduction. What I'd like to do now is I'd like to do a bit of hedging with you, okay? I'd like to go over a receivable hedging example, and then I'd like us to talk about some payables, okay? So if everyone can get out their calculators in our remaining time, we'll do a couple of examples. So we've laid out two pathways for a company to hedge its receivables, its incoming cash flows, which is one of the key skills a global manager needs in order to address operating in a global environment where there are multiple currencies. So we said you can either pursue a forward hedge or money market hedge. As we point out here, with the forward hedge, you're just negotiating a contract to sell your foreign exchange equal to your accounts receivable at an agreed upon strike price at some point in the future, right? With the money market hedge, all you're doing is you're borrowing against your receivables. You're borrowing against your receivables in the local currency. You're converting the currency into your home country. And then in our examples, we're saying you can invest it. You're investing it in the markets. You may not invest it in the markets. You may pull it out of the foreign local market and deploy it not only at home in any way that you like or in any other market that you like. The point is to get your cash out of the market today and not wait for the receivable, okay? So let's look at an example here. We say that the company OTT, can somebody read that for me because my thing is blocked up top? Oh, I got it. So he said OTT is going to receive Swiss franc 200,000 in 1 year. The forward rate on the franc is 50 cents, and the spot rate of the Swiss franc is 48 cents. That means that the market is soft on the market is hard on the. I'm sorry. The forward rate on the Swiss franc is 50 cents, and the spot rate on the Swiss franc is 48 cents. That means that the franc gets me 48 cents today. In 6 months, or the forward rate, it's going to get me 50 cents. So is the market hard or soft on the franc, the Swiss franc?
Hard.
It's hard on the Swiss franc. So if they use a money market hedge and then they deposit the proceeds, how much money will it receive, assuming the following rates? I give you rates, the 1-year borrow and deposit rates in US and Switzerland. Excuse me. So what's the company going to do? Well, first, the company could use a forward hedge. Excuse me. First, the company could use a forward. The first company, excuse me, could use a forward hedge. I'm sorry. Pardon me. The forward rate is 50 cents, so it's 50 cents times 200,000. The cost is going to be 100,000. But let's look at what they're doing with the money market hedge. Well, they're going to have to borrow in Switzerland, and they're going to have to convert it and then deposit it in the US. So let's see. The amount to borrow, you've got to discount the future value. So you discount it by the prevailing rate in Switzerland at the prevailing borrow rate in Switzerland, which is 5%, which means your 200,000 receivable is worth 190,476 today using the relevant rate, which is the borrow rate in Switzerland, because you're borrowing against your Swiss franc receivables. Now, the value of that at the prevailing spot rate is 91,428. If you take that 91,428 and you invest it in the US at the prevailing deposit rate in the US at 6%, you end up with 96,914. Does everyone see that?
Yes.
Good. So if the firm pursues a forward hedge, what would the proceeds be, and what's the break-even rate with the money market hedge? So the forward rate, as we said, at 50 cents per unit gives us we're gonna have $100,000. We're gonna optimize our return. We're gonna get $100,000. So which is the better of the two methods?
The forward.
The forward hedge. What's the break-even rate between the two? Well, you have to say what's the amount, the proceeds received, the US dollar proceeds received from the loan, which is the 91,428, not the 96,914, which is the loan proceeds, dollar loan proceeds after you've invested them. So before you've invested them, the cash you get at time 0 is 91,428. You multiply that value times your 1 plus R, gives you equated to 100,000. The proceeds you would get from the forward hedge, and your rate, if you solve for R, is 9.4%. Okay, so now let's look at an example. Are there any questions here before I move on?
Where did we get the 9.4%?
Well, say 100,000 divided by 91,428. Subtract the 1, gives you 9.4%. That's the break-even rate, the rate at which I would be indifferent given constant transaction costs between the forward and the money market hedge.
Yeah, I got it. Sorry.
Professor?
Yeah.
So I understand the solution where is you convert it today and then you deposit and invest it in the US. But the forward hedge, can you explain just how you would do that? So
sure, you
right
come to me, I'm the bank, I'm Citibank, and you say to me, I got a 200,000 Swiss franc coming in 6 months. At what rate will you exchange them? I say 50 cents a unit. That's your cost. I mean, that's your proceeds. Your proceeds will be $100,000.
Okay, I understand.
Yep.
Thank you.
Okay. Now we turn to the cost side of the ledger. These are proceeds. Now we turn to the cost side of the ledger when you have an accounts payable due. So we talked about the Brazilian car dealer. She sells Toyotas in Brazil. Toyota sends her the cars, $3 million worth of cars. They give her 9 months to pay off the cars. That means she's got a yen payable in 9 months of $3 million. Her concern is that if the Brazilian real weakens, that her cost in real to purchase the yen is going to increase. Now, Toyota is not willing to accept the foreign exchange risk. What they do, the car dealers, international car dealers like Toyota, is they provide zero cost financing. They're giving the cars to the dealer in Brazil. She needs money to pay for her lights and her employees and all of the other expenses of running a business, and they're not asking her for any interest on that. All they want is their money back in 9 months. Why 9 months? Because they know to sell those $3 million worth of cars should take 9 months. That's the understanding. What our Brazilian car dealer has is a potential problem because she's got enormous foreign exchange risk. So let's look here. We have an accounts payable due in 3 months of Malaysian ringgit, 500,000. We owe 500,000 ringgit in 3 months. Instead of borrowing against our receivable, we're going to invest against our payables. We're going to invest an amount of money in the local bank that will go to equal the payable that's due in 3 months' time. So the bar rate in the US is 225. The Malaysian deposit rate for 3 months is 360. The forward ringgit rate is 28 cents. And the ringgit spot rate is 29 cents. So that means that the market is soft on the ringgit because it's saying no, it's not. It's hard on the ringgit because it's saying that in 3 months, the dollar is going to buy fewer ringgit.
Oh, Professor, could you clarify what ringgit is? Is that the currency?
The Malaysian ringgit is the currency.
Okay.
Right. So the forward hedge, lots of manufacturers produce in Malaysia. Why?
Cheaper.
Cheap labor. Cheap. That's exactly right. So the forward hedge at 28 cents, if we convert it 28 cents, that means my cost in 28 days, in 90 days, pardon me, 3 months is going to be $140,000. Conversely, if we do a money market hedge, I've got to deposit an amount in Malaysia at the prevailing rate, which is 3.6%. So I've got to discount my payable that's due of 500,000 ringgit at the prevailing rate of 3.6%, means that I've got to deposit ringgit 482,625 today in a local bank that in 3 months' time at 3.6% is going to grow to 500,000 ringgit. So that what this will allow me to do is to eliminate my foreign exchange risk at time 0. Okay, so the dollar cost of that initial deposit, 482,625, is going to be at the spot rate, 29.48 cents, which means the value of the deposit is 142,277. The question is where am I going to get the money, the 142,277 that I'm going to convert at the current spot rate, the ringgit dollar spot rate, to get me my 482,625? Well, I'm going to borrow it in the US at 2.25%. If I borrow 142,277 in the US at 2.25%, it's going to cost me 145,479. I borrowed 142,277 in a US bank. I've converted into ringgit 482,625, which I then deposit in a Malaysian bank at 3.6%. That gives me my $500,000, my 500,000 ringgit in 3 months' time. So what do we see? That with the forward hedge, our cost is 140,000. With a money market hedge, the cost is more. It's 5,400 and change more. So obviously, you're going to take the forward hedge. What's important here is the mechanics of understanding the mechanics of the payable hedge. So let's look at one more. Pardon me, yeah.
I think the calculation is not right because you put the present value of 3.6% for entire year and not for 3 months.
Right. No, the numbers are right.
That's the 3 months
The
borrow
whole
rate.
transaction is taking place in 3 months. The 3 month, I gave you 3 month rates.
Oh,
So
the rate
I'm-
itself is
I'm
small.
borrowing for 3 months and I'm investing for 3 months.
Okay, thanks.
So Professor, when you say this is softened in foreign head, can you please clarify a little bit more when you say when this one is soft and the other one is not?
I mean, okay, sure. Right now, if you look here, the spot rate for the ringgit is 29.48 cents. $1, one ringgit gets me 29.48 cents. In 3 months, the ringgit's going to get me 28 cents according to the market. That means that the expectation is that the ringgit will weaken in 3 months and get me fewer dollars in 3 months than it does today. So the market is soft. The market thinks that the ringgit will weaken or soften in 3 months.
Oh, I understand. So it's gonna decrease. Yeah, okay. It's
That's
decreasing
exactly
over
right.
the body.
As opposed to if the forward rate was 30 cents, we'd say that the market was hard on the ringgit because it expects it to strengthen.
I understand. Now, okay. Thank you.
So in our remaining 2 minutes, let's just run through a quick problem. Here you have a pound payable of in 6 months due in 6 months of 200,000. I gave you the 6-month borrow rate in the US, the deposit rate in the UK, and the forward and spot rate for the pound. Here, the pound, the market's view on the pound is also that the pound is soft because today it buys 202, expectation will buy a cent less in 6 months. So the forward hedge is easy. 200,000 times 201 means it's going to cost me 402,000 to satisfy that payable. Yes?
Yeah.
With the money market hedge, I'm going to deposit it in the UK an amount that's going to grow at 5% to equal what I owe, 200,000 pounds. So if I discount the 200,000, that means at 5%, that means that the pound payable equates to 190,476 pounds today, which I need to deposit at 5% in the UK to get to my 200,000 payable. Well, what is the US dollar value of that? Well, at the spot rate of 202, it's 384,762. If I borrow this in the US at 384,762 at the US borrow rate, 6-month borrow rate of 4%, what's that going to cost me? It's going to cost me 400,152. So which is the better of the two techniques here? It's obviously the money market hedge. It's the money market hedge. So that's it for tonight, folks. I want to thank you very much. I'm going to post all of these slides for you in the next hour. Let me remind you that, again, answers to Chapter 1 questions and the capital markets review problems that I posted for you are all online. One final, some of you, I responded to a bunch of emails. Some of you wrote me multiple part questions that I'm very happy to have and I'm working on, and we'll get back to you, a few of you, over the course of the next couple of days. I apologize. As you know, I was traveling last week. I was down south a bit. I'm back in New York in my office, and I will get back to you forthwith. Yamu has a question. What's that?
Hey, I know that the midterm is coming soon in a couple of weeks, so I just wanted to know your exam format. Is it mostly calculations?
It's going to be true, false, and multiple choice. We're 7 classes away from the midterm, so you're a little bit ahead of yourself. I understand it's on your mind. I think it's on the 26th. We've got 7 classes to go. The exam will be true, false, and multiple choice. There'll be theory and there'll be calculations. I promise you that as we get closer, I'm going to give you review sheets, and when I write the exam, I will give you further color on that, further clarification. Okay, Yamu?
Professor, is it on the 24th or the 26th?
It's the 24th, I think.
I don't have. Hold on, folks. I'm sure that I'm sure I'm right. I'm sure I'm wrong. It's the 24th. That's exactly right. Thank you for the clarification. I wish all of you